Welcome back to QAV America, Tony, episode 31. Big news in America, Tony. The Fed is meeting. Rate cut widely expected. Markets are pricing in a 90% chance that the Fed will cut rates by 25 basis points today, tomorrow. We'll see what happens. It's driven a big rally across equities in the US, a Santa Claus year-end rally, they're saying. But we were just talking on our Australian show about our Reserve Bank that's meeting today, that's going to decide what they're doing about interest rates. And it doesn't really matter a great deal to us. It can have an impact on the broader economy, but from a QAV perspective, we play the cards as they're dealt. Interest rates go up, interest rates go down. Doesn't really affect our system one jot, does it?
No, I mean, it may cause us a bit of work if we have to buy and sell something, but no, we don't rely on macro themes at all, nor can I explain them most times, and even more remotely can I predict them. So I don't even try.
On the Australian show, I was just reading out results from some of our Australian listeners following our system. One guy was saying his portfolio's up 90% this year. Another was saying it's up 55% this year. Great results across the board, and it's a good year in the Australian market as well as in the US market. Our portfolios are doing well. But as we were talking about, it's just the system just tells us what to do, tells us what to buy, what to sell, when to sell. And what I've learned to do in the years we've been doing the show is just follow the system. It removes all of the emotion from it. And it also means I don't really need to follow what's happening in macroeconomics or in the market, generally speaking, because the system factors all of that in. It works in boom cycles. It works in bear cycles. It works if interest rates are high. It works if interest rates are low. It really just tells us what to do. And I don't really need to do much at all. As I was saying on the Australian show, if one of my alerts goes off and says I need to sell something, I sell it, I replace it, and then I go back to what I was doing before and just ignore the noise, which is a great way to invest.
It's the only way to invest, I think. And I just want to add one more thing to that, and that is that because of that, I guess the number one thing you can have as a trait to be an investor is persistence. It's just, if you know your system's going to work in all kinds of ups and downs and market situations, and it has for me over decades, then rely on it. Don't start second guessing it. Don't start saying, oh, it's been a really good year. Because I've had a good year on the share market this year. And straight away my brain goes, ooh, maybe it's time to sell. What, can we have 2 good years in a row? What about 3? Can we have 3 good years in it? Which it's like they're just fool's errands trying to work out what's going to come next.
Yeah. So
you have a system and you stick to it. And if the market does turn down, you stick to it because you'll ride it through and then you'll catch it reasonably a low point on its way back up again.
Yeah. Well, speaking of portfolios, looking at our US portfolio in Stockopedia, it's up around about 3% this month versus the S&P 500 up about 1.75%. All time, our portfolio is up around about 58%, which all time for this US portfolio is from September 2023, so just over a couple of years, versus the S&P 500 up 54%. So we're doing a little bit better than the market over that time. And there's an interesting story I saw in Morningstar, Tony, about rotation away from mega caps in the US towards value, small cap, and core stocks. This is dated 4th of December in Morningstar. Article says, as of November 28, 2025, the US equity market was trading at a 3% discount to a composite of our fair value estimates of the over 700 stocks we cover that trade on US exchanges. Later on in the article, he says small cap stocks outperformed in November as the Morningstar US Small Cap Index rose 2.48%. Comparatively, Morningstar's US Mid Cap Index rose 0.64%, and the US Large Cap Index declined 0.05%. Small cap stocks remain the most undervalued, trading at a 15% discount to fair value compared with large cap and mid cap trading at 3% and 2% discounts, respectively. But obviously, we've talked on earlier episodes that like the Mag 7 has been like 70% of the market's growth or performance this year. So the fact that it's coming off a bit, it doesn't really discount the impact that it's had on the market over the course of the year. But when I look at our buy list, US buy list each week, there's still just plenty of opportunity at the small and mid cap market space, which just seems to be getting ignored by the general market for some reason. I don't know why we're seeing so much opportunity of stocks that are showing up as undervalued, but it's a good time for us.
Well, I think, it's been a tale of two markets, perhaps three markets really, in Australia and in the US. Mag 7 have driven the growth, and I guess if you can cast that net a little wider into things like data centers and power supplies to data centers, that kind of thing, have all been dragged up in the AI revolution. But that, if you exclude that from the market, it's been reasonably flat, or certainly it hasn't been growing as quickly as all that. But what we also found in Australia, and I guess it's the same in the US, is that with a lot of passive investing done these days, and even if it's not passive investing, if it's big active fund managers, because of their size, they still are buying into big caps. And that's kind of opened the space a bit in the smaller cap market for stock pickers to come in and pick the pies out of it and do really well, because you're not, it's small caps go through cycles. They outperform and underperform. They've been underperforming recently. So as people sort of wake up to the fact that there's not as much passive investment in the small cap universe, it's doing better.
Yeah, well, just running through some of the stocks in our portfolio, some of the best performers over the last couple of years. Willis Lease Finance, we talked about them again on the show last week. They do plane engine leasing, I think. They're up 168% since we bought them. Innova International, ENVA, they're an online financial services company. They're up 127%. Euroseas Limited, ESEA, they're in the shipping business, dry bulk and container carrier stuff. They're up 120%. BLX, the Foreign Trade Bank of Latin America, is what it says on the label. They're up 82% since we bought them. Regional Management, RM, Diversified Consumer Finance Company, they're up 57%. Sarkos Energy Navigation, TEN, they're a Greek-based crude oil shipping company. They're up 40% since we bought them. The list goes on. So, these are companies I'd certainly never heard of before we started doing the show. I would gather most Americans and most American investors have never heard of these companies. They're not well-known brand names. They're your classic sort of, as we often say, classic Berkshire-type companies.
Yeah.
They're just boring businesses that have got a line of business they've been in for decades. They've got good customer relationships, supplier relationships. They generate cash. And because they're boring, we're able to get them when they're at a discount to their valuation, and then we just write it out.
Yep.
Regression to the mean. Some of the stocks that we've talked about on the show but don't necessarily own, the ones that I've done deep dives on over the last year that have done well, Chemex Corporation, CX is the ticker code. They're up 94% since I talked about them in March of 25. Canadian Imperial Bank of Commerce, CM, is up 40% since I talked about them in May. Ford Motor Company is up 22%. IHS Holding is up 39%. Precision Drilling Corporation, PDS, we talked about them in June. They're up 42%. Zepp, of course, the Chinese smartwatch company, is still up 825% since we talked about them in July. That's the outlier. Sasol is up 22%. And there's a lot of others that are up 9-10%. Community Health Systems is up 10%. The ones that haven't done as well, just to be fair, Titan Machinery is down 17% since I talked about them in August. Calmaine Foods is down 10% since I talked about them in October. The world's most hated energy company, PCG, is down 5% since I talked about it in November. So it seems like Reddit might have been right on that one. Korean Electric Power that we talked about last week is up 3% since we covered those. But anyway, Oryx Corporation, IX is up 32%. POSCO's up 11%, So there's been a lot of opportunity even with these companies that, we've all heard of Ford, obviously, but I'd certainly never heard of Zepp. Now they're up 825%. So American Airline Group is up 8% since we talked about them in October. Topgolf is up 6%. Callaway. So anyway, they're doing okay.
Yeah, they are. And who knows what will happen after interest rates get decided upon Thursday morning our time. It could drive another leg up for those kind of companies. But the interesting thing is, like, you take a stock like Oryx, right? It's been around for a long time. It's not doing anything sort of groundbreaking. From memory, it's a leasing company and Japanese-based. It's mature. It's grown a lot over the years, but as far as I know, isn't growing hectically now. Again, it's up 30%. So the only thing that can explain that to me, and I'll go out on the limb with this, is to say that people have just understood it's undervalued, and they're buying into it, for the same reasons that attracted us. That eventually it'll regress to the mean.
Well, they listened to the podcast. That's what explains it. I talked about it, and they figured it out. Big news. What else? There's big news in the US today. Obviously, the whole Netflix Paramount battle over Warner Brothers Discovery is going on. Netflix sounded like they'd landed the deal, which is going to give them all of the Warner Brothers films plus HBO. Not CNN though, but then Paramount's come out today and tried to do a direct to shareholder thing to get around the board and get the shareholders to back them. I did see one.
So did Donald Trump. Came out and said he wasn't sure Netflix was in the best interest of US consumers to have such a big player in the streaming market. But that has also had a bit to do with Paramount as well. Yeah,
but Larry Ellison, who's very pro-MAGA, and his son David Ellison owning everything, that's fine. So, but the other thing that's happened sort of tying in with this is there's a shift in the US Securities and Exchange Commission leadership. There's a new regime at the SEC aligned with the Trump administration, and that's apparently moving to weaken shareholder power. This is from Reuters. This news goes back to February that there was a change in the administration there, but the recent news is that they're pushing through rules or trying to push through rules which will dilute shareholder influence and empower corporate boards to just push ahead, weaken ESG governance stuff, put limits on shareholder proposals. So it's sort of this structural shift away from shareholder capitalism towards more of a managerial capitalism where the boards get to ignore shareholder demands for more corporate accountability or ESG pressures, or weaken the ability of activist investors to engage with companies and funds to engage with companies. So we'll see how that plays out. Be interesting to see if Buffett has any views on that before his retirement kicks in.
Yeah, interesting one. I mean, I think that some of that's in retaliation to the pendulum, which has swung too far. I know at some AGMs in Australia, someone can buy, a handful of shares and then get up and espouse why this company's no good for the environment or whatever. And I think a lot of shareholders are sick of it. So I don't know the laws that you're talking about, but I suppose that, that kind of taking things back towards, comment on our financials, but don't soapbox. Your policies at our AGMs might be behind some of that change too.
Well, we'll see how that plays out. But again, we'll just play the cards as they're dealt to us.
Correct.
Well, my deep dive this week, Tony, is a company I'm calling the FMG of Brazil. That's meaningful to Australians, but probably not to anyone outside of Australia. FMG is a very, very large Australian iron ore miner. And this company, Vale, is the largest producer of iron ore and nickel in the world. They are a very, very large company, been around a long time. They also produce manganese, ferroalloys, copper, bauxite, potash, cobalt. They operate 9 hydroelectricity plants, a large network of railroads, ships, and ports. They arguably have been the largest producer of iron ore since 1974, although Rio Tinto might argue that. Rio Tinto and Vale are often quoted as the world's largest iron ore producer, depending on the specific year and whether or not you count shipments versus production. But as I said, they've had this title since 1974, and I was just wondering, Tony, do you want to take a guess at what some of the top 10 US pop chart hits of 1974 were?
Ooh. That's back in the disco era, so maybe Donna Summer, I'm going to say.
No Donna Summer.
No. Okay.
And in fact, the top 10 didn't have a lot of disco.
Really?
It's kind of slightly pre-disco, I think, 74. The number one song was The Way We Were by Barbra Streisand. Probably the least disco song ever to chart. Terry Jacks' Seasons in the Sun was number 2.
Mm-hmm.
Love's Theme by Love Unlimited Orchestra could have been the beginnings of disco. It sort of has a bit of that going on, a bit lower tempo than disco, but it's got a bit of the groove going on. Dancing Machine by the Jackson 5, Grand Funk Railroad's version of The Locomotion, Australians know from Kylie Minogue's first big hit. Benny and the Jets by Elton John was number 9. Again, not very disco, but not a bad track. Anyway, enough of that. So, Vale is basically Brazil's iron ore and base metals machine, digs up iron ore, turns it into pellets and higher grade products for steel makers, sells copper and nickel into the energy transition story. And from 2000 to 2006, they invested more than $1.3 billion on the acquisition of over 361 locomotives and around 14,000 freight cars for iron ore transportation, and some are for regular cargo. So that's basically what they do. They pull stuff out of the ground and they sell it. We're very familiar with those sorts of businesses in Australia. A large percentage of our portfolio at most stages involves companies that dig things out of the ground.
Yep.
Depending on where the commodity cycle's at, and iron ore is actually in a buy state for us at the moment. It hasn't been for the last couple of years, but has been recently. So that means we can look at companies like this. This company started life in 1942 as a state-owned company called Companhia Vale do Rio Doce, created by the Brazilian government to monetize the Doce River Valley's iron ore and help industrialize the company, privatized in 1997. And since then, it has morphed into a global mining giant. But it has some dark stories, Tony. You know I love a good...
Oh, no. I might go and
tragedy.
make a cup of coffee.
Yeah.
And I don't know the Vale story that well, but I know BHP and Rio both had those kinds of pasts as well.
Well, BHP is part of this one, so there you go.
Yeah.
And in fact, a couple of weeks ago, yeah, well, I'll get it. So it's had 2 dam disasters in the last decade.
Because iron ore
first
mining
one-
often involves what they call a tailings dam that you can run the offshoots or the offcuts through. Yeah.
Why don't you explain what a tailings dam is to the listeners,
No,
Tony?
that's about all I know, Cam. An iron ore mine involves a dam.
All right, Ray. I had to look this up. Basically, just the sludge from the mine gets built up upstream, and then you keep adding to it and adding to it and adding to it. And it's not very stable, is the bottom line. It can look stable, but it's not. And in fact, they've now been pretty much outlawed all around the world, largely as a result of what happened to these 2 dams. The first one was in 2015, the Samarco joint venture dam failure at a place called Mariana sent a sludge wave down the Doce River, killed 19 people, created billions and billions of dollars of damage, killed all sorts of animal, fish and plant life, and destroyed property. And BHP Billiton, good Australian company, well, Australian, British, depending on how you slice it, was a 50% owner of Samarco. So they got embroiled in the court cases that came after this. And in fact, just a couple of weeks ago, 14th of November 2025, the High Court in England ruled that the BHP Group was liable for the disaster, citing negligence, technical warnings, and a lack of essential studies, which permitted the height of the dam to increase beyond safe levels. There's been massive lawsuits from the Brazilian government and from shareholders, because the share price, I think, for Vale dropped like 50% when this thing happened. There were big class actions, criminal lawsuits against executives and former executives for allowing this to happen. BHP, of course, as a good corporate citizen, is appealing the High Court's ruling and denying all involvement in it. Then, 4 years later, after the 2015 disaster, another dam failed at a place called Brumadinho, which killed 270 people, and most of them were employees of the company. 3 locomotives and 132 wagons were buried, and 4 railway workers were missing. So, again, lots of fines, charges, management style shake-ups, class actions, and share price collapse.
But no reinforcing of the dams.
Well,
the first one, shouldn't have happened, but did. The second one, after you know about the first one, is much worse, I think.
Yeah. Once in a lifetime thing, Tony, could never happen again. Bit like climate change disasters that we have in Australia, can never happen again. If you look at the share price, I have to go back a bit further than that. Share price in 2008 for this company was trading at about $41. It had already been declining. 2015, it was down to $5.70, dropped down to $2.98 after the first disaster, climbed back up to $12. Then the second disaster happened, dropped down to $7.66. Since then, it's been on a bit of a ride, got up to $22 in 2021, and it's back down to about $13 now. But, they've done a little bit of work on fixing this. As I said before, after these happened, pretty much the entire world banned these tailings dam solutions, and everyone's had to figure out better solutions. I think they've been doing that. But the bottom line from our perspective, like, disasters are terrible. And, it's one of those things that I think the market looks at companies like this and sees red alerts, red lights flashing because it's had two disasters in living memory. But from our perspective, it generates a lot of cash when it doesn't have a disaster, and it's a pretty profitable business. If we look at where it's at today, still mostly iron ore. But it reports in real, Brazilian real, if you look on Stockopedia. But if you do the translation into USD, I think its revenue in 2024 was about 31.4 billion. Sorry, that was coming from just the iron side of the business. The energy transition metals, the copper and nickel business added about 6.6 US billion, which is about 70% of the revenue. So that's pretty much what they're doing, chasing higher grade, higher margin iron ore tons and trying to lift their output at Carajás. Decarbonisation, they're targeting 33% lower operational emissions by 2030 and net zero by 2050, with 100% renewables already reached in Brazil. But they've got a lot of legal cases going through that could affect them. By the way, I did some comparison between them and FMG just for the Australian listeners, if they're interested. Vale reported iron ore output in 2024 was about 328 million tonnes. By contrast, FMG shipped 192 to 194 million tonnes. So makes Vale roughly 1.7 times larger in annual output by tonnage than FMG. So they're the global heavyweight, but FMG's major, but clearly second tier if you stack them head to head. In terms of country rankings, Australia and Brazil are the two top global iron ore powerhouses. China, India, and Russia come after them. Brazil's iron ore reserves remain among the world's largest. Australia is up there, particularly the Pilbara region, but it's really between Brazil and Australia as the two global iron ore behemoths.
And with something developing in Africa too, which is interesting.
Oh, yeah?
Yeah, I think it's in Guinea. We were talking about a Perseus Mining, an Australian gold miner operating in Guinea, but there's a big, I think it's iron ore coming in a place called Samandu in Guinea in Africa, which is supposed to also be of a world-class type nature and what they can mine and export.
Right. Well, that might add some interest to it. And obviously a lot...
The other thing too, sorry, Cam, for interrupting, is companies like BHP are actively trying to get more into copper than iron ore these days. So I'm not saying there's not a future for steel around the world. There obviously is. But the big wave in iron ore mining and exporting was when China was doing double-digit growth in the 90s and early 2000s, and using steel hand over fist. And that's come off the boil. It's still quite strong. China's economy is growing at 5 or 6%, which is nothing to be sneezed at. But, you look at companies like Fortescue, as you mentioned, its value went from like less than $1 to $20 odd in share price. BHP and Rio haven't done as well. BHP, had a lot of false steps with acquisitions along the way. And it looks like Vale hasn't done as well either during that sort of golden year of iron ore mining and exporting. So it'll be interesting to see how they go going forward if iron ore is still important, but not as strong in terms of its demand going forward.
Yeah, it's interesting. I haven't done this, but if I compare the charts, so as I said, if I look at Vale's 10-year chart, it's 10-year looks all right. The share price 10 years ago was about $3. Now it's about 12, 13, so about 4 times. If I look at FMG's 10-year chart, 2015, it was trading at the end of the year around $2. and it's currently about $22.
Hmm.
So it's done far better in terms of its share price growth over that period anyway. But it sort of grew from a small
It
operation
did.
into a
Yeah.
pretty big operation at that time, right?
Yeah, and it also
Starting
FMG
from a lower base.
FMG has made a niche for itself in selling lower grade iron ore into China. So when
Yeah,
there was so much demand for iron ore that China was happy to buy a lower grade, FMG capitalized on that. Whereas
jumped on that.
I'd be surprised. Vale's probably still in that market, but it probably also sells a lot better grade of iron ore as well.
Yeah. And of course, China, that was getting to my next point, is the biggest market for them as it is for Australian iron ore miners. Brazil in total exported about 37 million tonnes of iron ore in a recent monthly snapshot, and China imported about 24.26 million tonnes of that. So, by far the largest single market for Brazilian ore exports. And, I know that China's trying to sever its global trade as much as possible from exposure.
Well, it's
I'm not
imports
sure if they're going
anyway.
to be able to. Yes, it's imports, not its
Hmm.
exports. Keep the exports, just
Hmm.
get rid of the imports. So, we'll see if that has a big impact, I guess, on iron ore in coming years. They might just buy less from Australia because I'm not sure what their diplomatic relationship is with Brazil, with Lula. I'm not sure what Lula's relationship is with China, but I know the Australian relationship is bipolar. From a trade perspective, we love China, can't get enough of China. China's the best. From a military perspective, they're our greatest foe and our greatest enemy and the greatest threat to our security. So it's kind of weird.
It is.
Very weird. So, free cash engine is still iron ore for these guys. In 2024, they generated around 15 US billion dollars of adjusted EBITDA on about 38 US billion of revenue. Recurring free cash flows around 817 US million in Q4. And it's just like if you look at the stock doctor numbers, its total revenue has jumped a lot since 2019 was a low year. We're doing real here, not USD. 2019, about 145 billion real. Jumped up to about 293 in 2021 and then came back down to 206 billion in 2024. Estimate for 2025 will be about 207. So it's about a 7% CAGR over that period, but it spiked sort of just after COVID, during that COVID year, and has come down since then. But their operating profit has jumped from 12.8 billion in 2019 to the TTM this year is around about 42.5 billion. It was 55.5 billion real last year, 2024. And their net profit is tracking around, the estimate for 2025 is about 45.5 billion real. So it's making money hand over fist. Its operating margin, the average is around about 31%. TTM is about 20% this year, but it has been higher over the years, depending on the price of iron ore, I guess. It's got a lot of debt, but it's also sitting on a lot of cash, 33 billion real in cash. Net debt is about 66 billion. Net fixed assets, 339 billion real. Book value, 218 billion real. So it's huge and it's making a lot of money is the bottom line.
Just
Yeah.
the conversion rate, I think, is about 5-1 between the real and the US dollar, something like that. So divide those
I do
numbers
have
by
that in
5.
mind. Yeah, I'm not doing that in my head, but yeah, I did have to recalculate some numbers. Yeah. when I was doing our numbers. So what can I tell you about it? What is it doing? It's phasing out all of those upstream raised tailings dams, as I mentioned, the type that were used in the disasters. Um, Upstream dams were legally banned in Brazil after the disasters. They're reporting that all of their upstream raised structures are being decommissioned under their dam elimination program. You would hope that they would be decommissioning them quickly. They now have a formal tailings and dams management system to track this. There's a global industry standard now on tailings management, the GISTM, which has been widely accepted internationally, and they're apparently aligning their practices with that. They've got a formal process of hazard identification and risk analysis in place, which means they're periodically assessing all of the existing tailing structures for structural risk. You would have thought that would have been par for the course over the years anyway,
Yep.
but apparently not. So that's going on. They're trying to avoid that, which is a good thing. So hopefully no more massive dam failures for the company. I mean, as I said earlier, they're still facing lots of class actions and lawsuits that are being dragged out in the courts, and they might end up with lots of fines. I think both them and BHP have agreed to pay billions of dollars in damages and reconstruction and all of that kind of stuff from Brazil, and they're arguing in the courts that that they're taking their responsibility seriously and there's no need for further punishment or further reparations, but we'll see how that plays out. But dam failures can still occur. These are decades-old weaknesses in a lot of these places. There's no guarantee they won't have another one and the share price could take another hit. So those are sort of the big risks I see with companies like this. You've got all of the normal ESG pressures as well of mining companies and digging stuff out of the ground. It's that thing that we've seen happen in Australia, though, where some of the big funds won't buy some of our coal mining companies because of ESG concerns, but it means that the price looks good to QAV, and we can pick them up at a discount. I think these guys fit that category. There's like a whole bunch of nasty looking components on the surface, ESG issues, dam failings, tainted brands, all that kind of stuff.
I think in terms of the Australian perspective that people who are focused on ESG that has something to say about BHP or Rio or Fortescue, it's around the fact as well that there's a lot of coal used in converting iron ore into steel. And so it's a lot to do with what they call scope 3 reductions. So the miners do a bit of work, quite a lot of work on reducing their own emissions. For example, in the Australian case, they often build their own either wind or solar power plants to power the mines. But it's what the customers are doing with the iron ore, which is of concern to a lot of ESG-focused investors.
It's the trickle-on impacts, the secondary impacts.
And ESG investors, getting back to your point before about raising issues at AGMs, have tried to bring in a regime of scope 3 emissions control via the miners, which is pretty hard for the miners to do when they're trying to sell something to this customer to say, well, you can't use it. I'll sell it to you, but you can't mix it with coal to make steel.
Yeah, unless you clean up your act.
Yeah.
So, I mean, the one-line thesis for these guys is they're a dominant low-cost iron ore producer, high-grade deposits, fat cash generation. They pay a big dividend. Their dividend per share is fluctuated, but, it's an average of about 30% by the looks of it. It's been up as high as 14%. This year it's more like 4%, 0.68,
Hmm.
but it's quite a good yield, 6-7% yield. Downside, lots of red flags. Chinese steel demand, as we said, could be flaky. Brazilian political legal environment, other potential disasters, foreign exchange exposure. They report on Brazilian real, but the ADA trades in USD, so you got to be careful of that. But the punchline is they're a dirty cyclical cash gusher sitting on world-class iron ore.
Mm-hmm.
Question isn't whether or not it makes money, it's whether you're brave enough to sit through the politics, the mud, the commodity swings, and just let it play out, which is a classic QAV sort of a stock from my perspective.
Yeah. It's cheap for a
You know,
reason. It's a big company, even though demand might be slowing. It's still enough demand for steel around the world for iron ore companies to keep going for decades, if not forever. There is progress being made in terms of the clean production of steel. I think it's it's probably about 10% these days, but there are better ways of doing it than heating coal and putting it in a blast furnace, putting the iron ore in a blast furnace to make steel. So that's slowly taking hold across the factories in China and other places. So, yeah, I mean, this is one of the reasons why it's good to be an individual investor, because if you are worried about ESG concerns, you can do your research and you can screen on your buy list to not buy these stocks, or you can say, well, I use steel, which we all do, and I'm resigned to that fact, and the manufacturing of steel will slowly get cleaner. It hasn't happened yet, but it will improve, and I'm happy to buy a share off somebody else who may be selling for ESG concerns and hold this stock until it re-rates back to what we think is fair value.
well, just running through the numbers to finish up, average daily trade is about 412 million, so it's pretty big. The price to operating cash flow is 5.59, so getting close to our cutoff of 7, but definitely below it.
Mm.
In terms of the Stockopedia numbers, it kills. Quality rank is 92, so we score it for that. The stock rank is well, let me look over here. The stock rank is 99, so we score it for that. The F score is a 6 out of 9, so we score it for that. Its price is not less than our IV number 1, so we can't score it for that, but it is less than our IV number 2. I think IV number 2 was about $18, and it's trading around about just south of 13, $12.81 today. So scored it for that. The price is not less than the book. It's not less than the book plus 30, so I couldn't score it for either of those either. Book value growth is positive, so I got a score for that. P is not less than the yield. The yield, though, is higher than the bank debt. As I said, it's got a pretty strong yield. The forecast IV number 2 is not higher than twice the share price, so I couldn't score it for that. All up, it got a score of 10 out of 14, which is a QAV quality score of 71%. And a QAV score of 0.13. Puts it down on the lower part of our buy list this week. And by the way, if you're interested in what our buy list looked like this week, well, no, I won't go through it. But there was like 100 companies on our buy list again this week in the US. Like it's kind of, it's just so much opportunity over there at the moment. And as I said, well, I didn't say it before, but looking at the companies that I've done deep dives on over the course of the last year from the US, I've done 27 of them. 20 of them are in positive territory, 7 are in negative territory. So it's a win-lose ratio of about 74% of the companies that we've covered so far this year.
Wow.
Which is pretty good. So that is my pulled pork for this week. Do your own research. It's not a recommendation, but definitely worth checking out if you can get over the death toll and the dirty dams and the ESG issues of digging stuff out of the ground and having it smelted and all of that kind of stuff. It's a cash generation machine out of Brazil.
Very good. Thanks for that. We've covered a lot of overseas companies that are listed on the US stock market. I wouldn't mind if anyone who is listening to this can tell us if there is an issue with private investors buying ADA stock in the US. It seems to mean that these companies aren't as heavily bought as some of the other ones that might be listed. I'm not sure if that's the case, but it's a bit of a theme, so I just wondered if that was an issue.
We did talk about it on an earlier episode, how it's a little bit tricky for funds, etc., to buy, but I don't know about private investors. Yeah. All right. Well,
Okay.
that's it for this week. Thank you, Tony. Have
Thanks,
a good week.
Cam. You too. Bye.